Yeah, good afternoon all the participants for our GST sectorial series part 1, and today is the third day for the program. It started from 26th May, now it's and after that 2nd June, and today is 9th June. So I welcome CA Rajat Talati ji to take the session for webinar on GST on bulk trade and wholesale. Before that, I want to invite CA Amish Sangoi to formally introduce today's speaker, CA Rajat Talati. Amish, please. Amish? Amish, please introduce.
Yes. Thank you, Pinky Madam, for giving me this opportunity to introduce our today's learned speaker, CA Rajat Talati ji. CA Rajat Talati ji, partner, Talati and Company, Chartered Accountant, Mumbai. Qualification: BCom, LLB General, FCA, DBF, ICA, FI. Experience and professional contribution. Has experience over 30 years. After completing CA in 1986, joined father and brothers as a partner in their practice in the name of Talati and Company, Chartered Accountants. Concentrate practice on the sales tax side. Presently advising several leading Indian and foreign companies in the sales tax and the GST matters as a retainer. Presently is a business consultant for the various clients and is conducting GST impact analysis of the various corporates and MNCs. Was a member invitee of the Indirect Tax Committee of the Institute of Chartered Accountant of India at Delhi for the year 2017-18 and has been a member of such a committee for several years at WRC of ICAI Mumbai. He is also an active participant and a regular faculty group leader at the various seminars, study circles organized by Institute as well as the other independent bodies like GST, PAM, BCA, etc., including various trade associations for GST as well as VAT. Was president of Sales Tax Practitioner Association of Maharashtra for the year 2004-2005. Was associate editor of the Sales Tax Review published by STP Association of Maharashtra for 2 years, 1996-97 and 97-98. Co-authored of the publication A Guide to VAT Audit, all 3 editions and issues on MVAT audit published by WRC of ICAI. Co-authored a book titled Study Material on Sales Tax Laws in Maharashtra for the Beginners published by STPAM. Was convener of Sales Tax Study Circle conducted under the banner of WRC. Done research project on incidence of sales tax on plastic industries in various states of India. Was Honorable Joint Secretary of the All Indian Federation of Tax Practitioners for 3 years, 1997 to 1999. Was a member of the Research Committee of ICAI New Delhi. Last but not least, he is also done an extracurriculum activities, a nature lover, and has undertaken the various treks in the Upper Himalayas, trek to the Holy Kailash and Mansarovar, done the course of ice skiing. It's an amateur photographer. With this short brief introduction, I welcome you, sir. Over to you, sir.
Thank you. We have to cover today lot of discussion on the subject of GST implication on the bulk trade and wholesale. Now the agenda is also good enough, comprehensive one, as I said. Bulk trade business, I will take you through an overview of the industry that I am going to talk about. There are different elements of sale price and valuation where one will have to have a look at it. We'll then touch upon certain typical business transaction and models which these size of large wholesalers undertake. There are certain problem areas in terms of import exports and the refund mechanism. The recent controversy of RCM on the ocean freight, of course, and some ITC related passing queries will also take it up, and time permitting we will take certain questions on the subject. Now let's have a look at the overview of the business that I'm going to talk about. Now these are the large wholesalers. Now what are these wholesalers? They are typically into agri produce. Now agri produce will also include wheat and paddy, and to cotton, oil seeds, edible oil, chemicals, minerals and ores, gases, liquid cargo in bulk, in tanker, in the stored tanks. Talk about steel industry, the cement industry, etc. So all these are different industries where they deal into large quantities of the goods which they deal into. The margins are very thin. The volume of business is very large. So error in judgment in terms of the implication of GST, if I were to say, would cost the company very dear. If the rate of tax is on a certain product is, let us say, just 5%, since the margins are very thin, it is running between 2 to 4%. If there is a loss of ITC of say 5% on the input side, this is going to cost heavily for the business. Similarly, if the on the output side, if tax rate is wrongly selected, instead of 12%, 5% is collected, or if instead of 18%, 12% is collected and 6% is asked to be paid from the pocket, is going to be costing very heavily to the industry because the margins are very, very thin. When we talk about dispatches, these dispatches normally take in the truckloads or the wagon loads, or at times the full rack of the goods train or the charter ship or the entire container load is traded. So the large volume that I am talking about. Now, the procurement for this industry typically happens from either the large wholesalers, or in case of agri produce, it is typically purchased from the mandis, or if it is ores, it is procured directly from the miners. The large importers also trade in huge quantities. There are government agencies like Cotton Corporation of India, MMTC, Steel Authority, of course, is a manufacturer, and there are other what we call is government agencies who trade into this volume business. Large international players are also there in the market. Typically, the MNC, the multinational companies, have their Indian entities, or they have subsidiaries in India or a representative in India who help to trade in these large volume businesses. So what we are talking is a large business with small margin. So the compliances or the implication for error are huge in numbers. Let's look at certain price elements. Now, if you're looking at quality allowance, I'm taking first, these are typical. I'm not touching upon the routine elements of price. We are talking about only niche areas or the typical areas of the business, the quality allowance. Now, what happens is, let us say we are dealing in coal or say cotton. There could be certain element of the quality which is expected. So when the purchase order is issued or when the agreement for purchase is entered into, let us say if I'm buying coal from a coal mine, the buyer would typically put up conditions like what is going to be the carbon content, what is going to be the moisture content. Now, if there is a uh, moisture content more than the expected, then there is always a case of raising the issue of the quality. Since the business is bulk, the sample taken is also randomly taken, and it takes time for the dispute to get resolved, and typically ends up in the arbitration. You would have come across certain cases where the dispute of say 2015-16 getting settled in the year 2019. Now, what has happened is, let us say when you have a purchase is effected from say Western India coalfield for the coal, we would have agreed for a price of say 100. Arbitration award comes after 3 years, which says that the price is going to be 99. Now, the first implication is, how do you tackle such price differences? Obviously, the arbitration award would require the supplier to give a credit note. Now, this credit note typically would be after say 2 years, 3 years, or 4 years. In the GST, there is no concept of credit note being issued within a period of say 6 months of the end of the year. That credit note, if I were to say, is on account of the event which has crystallized the credit note, which is happening after say 2 years or 3 years, such arbitration award will have to be given the effect in the GSTR1 in the period for which it is received. Now, the example which I gave was a very typical example. The original supply took place in the year, say 2015. The award is received in the year 2019. Such cases, there is no GST implication. The answer is very simple. The taxable event of supply or the sale, as it was called under the original sales tax laws, took place before the onset of the GST, before the introduction of GST, and therefore when the award is received, that will have impact on the old VAT law and not under the GST Act. Now, under the old VAT Act, one can ask for the credit in the hands of the seller in respect of the tax implication on the uh, quality allowance. Now, there are two issues one will have to consider here. A, if seller is successful, the buyer should have reduced the input tax credit of 2015. Now here the buyer, it is quite possible buyer would have claimed the full input tax credit. His assessment would have been over, where the full input tax credit based on the matching of the seller's reporting and the buyer's claim. Typically in the state of Maharashtra, we have annexure J1 and J2 getting matched of the form 704 of audit report. So if that is matched, the buyer would have claimed the full input tax credit. In such a case, it is advisable that seller does not claim the credit of the reduction in the sale price and hence reduction in the tax liability in his hands. So one will have to really be careful when advising the client, because the typical situation of buyer and seller and their position in the tax compliance will have to be taken into account. In GST also, one will have to uh, factor these aspects, whether to go for a financial credit note in such cases, or should we go for the credit note with the tax implication. One will have to really talk out very clearly with the buyer, with the recipient of the goods, and then take the call. Going to the quantity differences. Now, these large quantities which of goods when are moved, there could be normal loss or abnormal loss in the transportation or in the handling of the goods. When the cement bag is handled, every single time the cement bag is put on the floor, after handling it, there is a loss of some quantity of cement which is lost out of the handling of the stocks. Similarly, when the loose cargo is handled, say coal, say any other mineral, iron ore, there is always some loss of the quantity. If these are normal losses, one will have to see, compare it with the abnormal loss of, let us say, loss of quantity or handling quantity because of the, say, upturning of the truck because of the accident which it met. All these cases one will have to be careful about it when you see whether there is a reduction of the ITC on accounts of such cases. I am referring to 17.5H, because if it is a normal loss, one would say this is already factored and one would not be required to reduce ITC. If it is an abnormal loss, one would say that this was the quantity of goods which is lost. When the quantity is lost, one will be requiring to reduce the input tax credit on the purchase side, on the input side. At times we have certain categories of loss which is collected from the transporter if it is outside the accepted threshold. If there is a amount which is collected for transporter, would there be any implication under the GST? Now, well, if the amount is collected from the transporter, this would be recoupment of the or salvaging of the loss which was made in the quantities which is lost. One will have to see once again, if this is an abnormal loss, the ITC will have to be reduced, and the amount which is collected from the transporter, it is not on account of any services which the transporter has provided, and it is not an act of tolerating the loss by the transporter. It is a business loss which, as per the terms of the contractor, transporter has agreed to reimburse or to recoup or to so to say compensate the owner of the goods by under a contractual obligation, and hence it is not a case of tolerating an act of the transporter by the owner of the goods. And for that reason, in my view, there is no question of any impact or any implication for such receipt from the transporter. Now, transit insurance. One is always aware that when there is a transit insurance, one would be putting up the claim depending on the loss suffered. The insured is not expected to make profit out of the unfortunate situation of loss of goods. Now, in such a case, the insurance, you can recover the insurance claim. If there is no loss of ITC, one cannot even put up the claim of insurance, including the amount of ITC, because there is no question of any loss to the ITC. However, if there is a case which I talked about is like the truck meeting an accident and the quantity of the stock is lost, there is definitely ITC reversal. So the tip here is, in such case, when you put up a claim of insurance, you must add the financial loss of the ITC which is required to be reversed on account of the accident. In that case, your insurance claim should be of the higher amount inclusive of the reversal of ITC. Now, at times we have price variation clause. Typically, let us say if you are selling to a say transformer manufacturer, you are selling say copper wire to the transformer manufacturer. The transformer manufacturer would normally have a clause inserted whereby the price of the metal is linked to the price which is relevant, or it is indexed to the London Metal Exchange pricing. So if there is a increase or decrease in the pricing, my contract price will also increase or decrease. So this is typical of the supply contract of such large quantities of metal. In that case, my original price is reduced or increased because of the fluctuation in price at the metal stock exchange, or at the typically London Metal Stock Exchange. In that case, my prices would vary, and debit note or credit note with GST implication will have to be passed. Now let's look at certain elements of recoveries. Now, what do I mean by recoveries? These industry typically mention the word in the financial book as recoveries. No, it is not the case that there was a loss which is trying to be recouped or recovered. The recovery is other than the normal price of the sale of the goods. Let us say carry charge. What are these carry charge? Now, when I say enter into a contract for sale of cotton, I would say that you have to pick up these goods on 10th of June. And on 10th of June, if the buyer does not come up, I hold the stock and he comes on say 21st of June to pick up the stock. For this 11 days, my godown is occupied. I am paying warehousing charges. My sale recovery is delayed by 11 days because my typical credit period would start after the date of sale. My sale has, I mean, my lifting of the stock has happened on 11. For these 11 days, I am carrying the stock for him. I am paying the logistics charges of say warehousing or supervision at the godown which I have taken on hire, or whatever it is. So these expenditure are commonly known in the trade as carry charges. So these carry charges are also a typical term. Friends, I am not trying to say that these are novel recovery amounts or elements. What I'm trying to say is these are the normal terms which are used in the trade. We should be able to understand so that given the case, we can advise the client appropriately. Fairly, the carry charges, even if it is collected by way of a debit note, would also attract the applicable GST. When I say applicable GST, why? Because these carry charges would become part of the original supply. My original supplies recovery or the price of the original supply is increased because of the contractual term, which provided that if I delay the lifting of the stocks from a agreed date, the per day charges or a per week charges at rupees so and so is payable as per the original contract. So in that case, these carry charges also acquires the character of the sale of the goods, and accordingly the same rate of tax as it is applicable to the goods will have to be applied. Packing and forwarding is very simple. APMC cess, Agriculture Produce Market Committee cess. Now this cess is payable if the quantity is handled at the agriculture market or what we call is mandis. Now in such cases, these mandi cess is also collected. Although this cess is collected and paid to the APMC market committee, this cess is recovered by the seller from the buyer. So this cess will also become part of the sale price. The scrap sale is simple. The typical scrap which happens in these cases is the empty gunny bags. At times, sugar when it is exported, or not sugar, oil seeds which are exported, or some other bulk commodities, say wheat or rice, when it is exported, at times they are exported in loose in the container load. So when it is purchased from the mandi, it was purchased in the uh, sealed bags of say 30 kilograms or 50 kilograms each. So these empty bags are then sold. At times we have a reverse case where the quantity is purchased in loose and the foreign buyer wants it in a batch format. So in such cases, the buyer would the bulk trader would buy the carry the woven sack bag or the plastic bags to fill up this quantity and then sell. Warehouse charges, transportation. Now interest on delayed payment. Typically, the payment terms are defined, and interest for the delayed payment is also factored into the pricing. So what happens is, when there is a delay, interest is payable as per the section 15 of the CGST Act. Such interest would also attract GST, not now, but only when the interest is realized. So when the interest is realized, the GST is payable, and not at the time of raising debit note for the interest. So typically in the accounting, the debit notes for interest and its recovery are separately tracked, and it is subjected to or offered to the GST only in the time when the interest is recovered. Typically, after the debit note is raised, the buyers may come forward and ask for some reduction, citing various reasons, and maybe one being the COVID difficulties. And in such cases, such interest which is called upon to be paid is now renegotiated at a lower amount. The GST is payable only on the lesser amount. Obviously, appropriate credit note should also be passed in the books to reduce the amount of debit which was raised by way of a earlier debit note. Sale of empties we talked about, when we have gunny bags being sold after the emptying the same. Let's look at certain typical transaction. Now I will take up some transaction which typically takes place at the commodity exchange. The panelist or the thing host, am I going fast?
No, you are okay.
All right, thanks. Now I will take up the transaction on the commodity exchange. Now the actual delivery or rollover. Now this is what is important for us to take a understanding. At the commodity exchange, what happens is the transaction in future is entered into. There are cases where, fearing the fluctuation in the pricing, the hedging is also done by these large players. So they may buy short or go long depending on the market situation. Now these companies have a lot of market intelligence that they have based on the study that they conduct. So typically they have the perception of the market with them, based on which they entered into a future contract at the commodity exchange. Let us say I have entered into a contract to buy at a say 110 rupees on say 5th of May 2022. Now on 5th of May 2022, when the contract is to be uh, honored, the person who has entered into a sale contract on 5th of may come over and say, you can take the delivery because I have exercised my option to take the delivery thereon. Now, if I take the delivery, it amounts to delivering the goods. So GST is applicable. Now, how does the delivery take place? Typically, all these commodity exchange have what we call is the designated warehouses. So the buyer have to take the delivery from this designated warehouse, and similarly seller has to make available the stock at these designated warehouses. The seller and the buyer do not know who is the seller and who is the buyer. Only when the buyer exercises the option to take the delivery does the seller come to know that who is the buyer, and the buyer comes to know who is the seller. The seller cuts the invoices and the delivery is effected. This is how the transaction takes place. Now, if the buyer does not want to take the delivery on 5th of May, but he wants to roll over the transaction to, let us say, the next settlement, which is say on the 20th of May 22. In that case, he has to pay certain charges of rollover. Now, now these charges are paid to the commodity exchange, and which actually is earned by the person who has entered into a sale contract for a future date. Now these rollover charges, what is the implication of the GST thereon? Now that is to be examined first. Typically rollover charges are nothing but the charges for the loss of opportunity, the financial loss of opportunity, because of the price at the current rate on the 5th of May 22 vis-a-vis the agreed rate. Based on that, the rollover charges is fixed, and accordingly the financial transaction gets closed. There is no delivery of goods happening, no exchange of promises happen. It is purely squaring of the transaction and opening of the new transaction which takes place. So one future transaction is closed and the new future transaction is opened. In that case, what typically happen is it is nothing but a transaction in money and not having any implication for GST. One may also be wanting to examine, is it a transaction in security? Now, what happens is this is nothing but a forward contract, the contract in future. Now, under the Security Control Regulation Act, if I were to say section 200 and section 2 clause 101, security includes derivatives. So one would be inclined to say, and rightly so, that it is a transaction in security outside the purview of the GST. Now when I say it is outside the purview of GST, what would happen is, in such case, these transaction would not attract any what we call any GST liability on the seller or the buyer, as the case may be. However, one will have to be very alert about the definition of exempt supplies. The exempt supplies will include the transaction which is outside the purview of GST, which is not subjected to GST. Now, in that view of the matter, section rule 42 for reversal in terms of section 17(3) will get attracted, and common credits may have to be reversed on account of the ratio which will get applied. Once again, there is a controversy here. If I were to say for a commodity exchange, what are my common inputs that I have used? Before coming to the common, I will have to see whether I have used any resources, any input or input services, which is specifically for my output service or my business, which is in the security. If the answer is yes, to that extent I will have to disallow. If the answer is no, there is nothing to be disallowed or nothing to be reversed, as the case may be. However, if there are common expenses, maybe purely administrative office expenses, these may require reversal in view of rule 42. So this is very peculiar of the transaction at the commodity exchange. Now let's look at the washout transaction. Now these washout transactions are typically not at the commodity exchange, but these are entered into with one individual customer or the supplier, as the case may be. The contract now provides that the price fixed is, let us say, 100 rupees a kg, and the delivery schedule is also given and agreed upon. At times what happens is, because of the fluctuation in the pricing, let us say I have entered into a price supply for, say, oil seeds. The price of oil seeds may fluctuate in the local market, or as the case may be, international market. And on the date of taking the delivery, either the seller or the buyer may say that, look here, today the prices have fluctuated. It is not in my interest to execute the delivery contract, but I would rather want to compensate or receive the compensation from the other party. Now such compensation is either paid or received depending on the contractual term by either the buyer or the seller. The issue is this act of tolerating an act? Would it attract GST? Now here one will have to see whether this amounts to some sort of liquidated damages, where we have several advance ruling which says that this would attract GST at 18%, or whether I would say that this is a term of the contract which required me to compensate the other party if I were to back out of the contract. If I say this, what happens is that this becomes a mechanism under the contract for providing the other party the opportunity to back out of the contract by paying a certain sum. That does not mean that I have a supply for which there is a consideration. Now supply being tolerating an act and consideration being compensation. Now, and what is the other concept of supply? There has to be consideration for supply. There has to be a meeting of minds that I wanted to tolerate an act and he has compensated me for the such tolerating. If that is the meaning coming out of the contract, one would say that such tolerating an act will attract GST. However, in all these contracts, normally the terms are very clear to say that the mechanism for compensation is based on certain pricing which would be applying on the date of the, which will be ruling on the date of the delivery and vis-a-vis the contracted price. If the mechanism is very clear, mechanism provides the monetary consideration for the non fulfillment of the contractual terms, to my mind this does not amount to tolerating an act and should not attract any GST. Helpful reference can be made to a AR in the case of, it is a Punjab AR in case of Louis Dreyfus Company Limited. Now here the advanced ruling authority has agreed with the submission of the applicant, saying that such case GST is not payable. Now let's look at some international cross-border transactions, high sea sales and bond sales. Now when we're talking about sale on high seas, I will have to divide this transaction into two periods. Transaction before 1st of February 2019, when there was an amendment to the Schedule 3 and specific entry was brought in. Now what happens is that in such a case, the transaction is between the seller and the buyer before it touches the customs station or it crosses the customs station in the in India. Now it takes place before the goods actually cross the custom barriers in India. The concept is GST Act applicable to such a transaction? The idea is, what is the place of supply for such a case? If the supplier, if the location of the supplier is in India, because high sea sale is effected by a seller in India, and place of supply is outside India, this will be typically construed as a interstate sale in terms of section 12. Now what happens is, one will have to see that the entry in Schedule 3 was specifically brought in only from 1st of February 2019. Before that, there was a controversy based on certain advance ruling, based on certain understanding in the market as to whether these transactions will be subject to GST. Typically, IGST is payable on this transaction being an interstate sale only when the goods cross the customs station, because it has to be paid as per the customs valuation at the time when the custom duty is payable. Typically, customs duty is payable by the importer who imports the goods in India and not by the high sea seller. So it is argued and accepted in the case of BASF India by the advance ruling authority that in such case this would not be subjected to any tax under the GST. However, with the typical definition, the ITC of the common credits will have to be reversed in this case. Now what happens is that after the amendment to, or after the insertion of entry 8 in Schedule 3, this transaction is exempt specifically from the levy of GST. Now when this transaction is exempt under the GST, one would have to see whether any ITC reversal is required. There is important explanation which is added to section 17(3), which provides for a proportionate reversal of credit. Explanation to section 17(3) says that the definition of exempt will exclude the transaction which is covered under Schedule 3, barring the transaction of construction of building by the in the hands of the builder, etc., etc. I will not go into that detail, or barring the supply of land and building. Now that be the case, what is happening is in section 17(3) there is a specific exclusion, and there is no need for reversal of ITC with effect from 1/2/2019. Now let's look at the bond to bond sale and ex bond sale. When I say bond to bond sale, what I mean to say is the importer imports the goods, file for in bond bill of entry, as we call is bill of entry for home for warehousing, and he defers the duty of payment of custom duty to a later date. And when he makes the sale to another person in the custom bond area only, we call them such sale as bond to bond sale. In that case, the buyer also keeps the stocks in the custom bonded warehouse, and he also files the bill of entry for warehousing only. The customs duty is still not paid, it is deferred to a later date. In case of ex bond sale, what happens is the seller who has the goods in the bond makes the sales to the buyer who chooses to ex bond the stock by paying the customs duty by filing the bill of entry for home consumption. At times, the bondholder, the seller in the bond may also choose to file bill of entry for home consumption by paying the customs duty, and then in that case that goods become normal goods, because after the payment of customs duty the goods merge or become part of the common mass of Indian stocks. So that being the case, that goods become equal to the goods which is manufactured in India or which is produced in India. We have important circular issued by the Customs Department in November 2017, Customs Circular number 46 of 2017. It has created certain difficulties based on the interpretation which has carried out in that circular, which has stated that in case of bond also the IGST is payable in a peculiar examples which are given in the circular. There are 3 examples which are given which requires payment of IGST. To put things at rest and in view of the clear provisions under the IGST Act, which requires the payment of IGST only when the customs duty is payable, which happens only when the bill of entry for home consumption is filed, the circular 3 of 2018 is issued under IGST Act effective 1st of April 2018, and in such case for bond to bond supplies no GST is payable. Of course, when there is a ex bond transaction happening, as I mentioned a while back, what would happen is the bill of entry for home consumption is filed. That amount, the duty amount is then added to the value of the goods, and the basic value plus the customs duty value is added and becomes part of the sale price, and that amount is subjected to IGST or SNC GST as the case may be, depending on whether the transaction is interstate transaction or a intrastate transaction. Merchant trade. Now, what do you mean by a merchant trade or out sale or a drop shipment cargo? In this case, what happens is the goods are, say, purchased in Dubai and sold to, let us say, Singapore, or the goods are purchased from Indonesia and sold to Sri Lanka. The goods never enter the Indian soil. It never crosses the Indian customs station. So the issue is whether GST is payable thereon. Once again, we have some decisions which are, of course, advanced ruling decision which are against the SSE or against the applicant, and some are in favor. Now, when you look at the Kerala Synthite Industries Limited, which was a very early one, which has clearly stated that on such transaction, no IGST is payable. However, it categorically stated that in such cases, the ITC may be reversed because this will be part of the exempt supply. Of course, there is an amendment to Schedule 3 on account of this transaction also, and for that reason, after the amendment, no reversal is required of the ITC in such cases. because that is not termed as exempt for the purpose of application of section 17 into bracket 3. We have INA bearing India, which is a Maharashtra ruling, which also stated there is no GST payable. However, Gujarat Sterlite Technologies, the appellate advanced ruling authority, has hold against, and they've said that GST is payable. Of course, friends, these are large transactions with large exposures. One will have to take a very conscious call of applicability of GST on this transaction. To my mind also, GST is not applicable. And looking at from the commercial angle also, the buyer and buyer is somewhere in the other country. I have my supplier, let us say from Singapore, I have sold to say Dubai. In that case, my Dubai customer is not going to pay me any GST. It is not going to be revenue neutral because he is not going to be claiming ITC also. So for that reason also, it becomes very commercially inexpedient to enter into such a exposure. Nonetheless, one will have to be very clear about the risk factor which is involved. As I said, we have some favorable ruling of advance ruling that we have, and the provision of the act also, I believe, are very clear. One should not get carried away by the few of the advance ruling which are against. Let's move to some liquid cargo ex-tank delivery. Now what happens is that, let us say there is a edible oil tank which stores say 10 lakh liters of edible oil, degummed soybean oil. Now this oil is not owned by one person. This tank stores oil which is owned by 3-4 owners, A, B, C, D. Now all these guys have a goods which are stored in the common tank. Since it is liquid cargo, the entire cargo becomes commingled, because what happens is the liquids cannot be segregated that this belongs to A, this belongs to B, or this belongs to C, as the case may be. So they becomes homogeneous, one commingled goods. So the issue is there is a common storage facility. What is the place of supply in such cases? As such, if I were to sell X tank, so what happens is there are two issues where I am touching here. One, it is a commingled goods, and two, if I am making a sale X tank, the buyer may or may not take the delivery of the goods, may not effect movement of the goods. What happens is in this case is the buyer may choose to stock the cargo there and there only without moving it further. There is only intimation which goes to the tank owner or the warehousing facility, the tank warehousing facility, saying that instead of owner A, these goods now belong to owner C, owner X, owner P. Now that is the case. What happens is there is no involvement of any movement of the goods. So one will have to see place of supply based on section 10(1)(c), and accordingly the place of supply will be the place where the goods are stored at the time of supply. When I say commingled goods, what happens is there is no segregation of the ownership of the goods. So different suppliers having a common storage facility, now the buyer will come and wants to take the delivery. He will simply have the quantity of oil pumped out of the common facility. He may take 10 tons of delivery per truck. So, and when he purchase 50 tons, he would take 5 trucks loads of delivery. The tank will discharge the cargo directly into the large tanker trucks of 10 kgs each. And there the commingled goods is directly dispatched irrespective of the owner, because the same homogeneous type of goods are stored in one common tank. So and typically this happens when the ship comes with the cargo. it is offloaded into these shore tanks, the tanks which are on the shore of the what we call ports, and that is how these goods are commingled and stored, and which is owned by several people. What happens is the person who comes last normally takes the delivery and also is uh, uh, is is to get the sludge which gets settled at the bottom of the tank, or it is floating on the top of the tank. Now this sludge, if it is heavy, it settles down. If it is light, it is floating on the top. Now in such cases, the quality of this stock is not the prime quality. He is also saddled with the sludge. So sludge, he puts up the claim with the seller. Now the seller is in a dilemma. When he pumped in, he believed that he pumped in the good quality, but the sludge of the entire quantity is finally getting delivered when the buyer takes the delivery of the stocks. So in such cases, possibly there could be a sort of disagreement of the quality between the buyer and the seller. Of course, the market forces have evolved over the years, and they know that the person who takes the delivery last is saddled with this sludge. So, of course, there could be debit note, credit note on account of the quality of the material, etc. But this is what is important to understand, that such sludge also gets finally delivered. The another important thing is passing of the property of the ownership of the goods. Now I'm once again touching upon a case where the seller has stock in the common tank, or he has the entire stock of the tank. Now the buyer approaches him. The buyer wants to buy the stocks, but he doesn't want to pay, or he doesn't have money to pay for the entire stock of, let us say, 2000 tons, or say 10,000 tons. He would agree to take delivery on payment, but he has entered into a contract to buy entire 2000 tons. Now today he has money for say 100 tons. He will pay to the seller 100 tons, and he will allow 100 tons to be taken delivery of. Typically, on entering to an agreement, the seller would also want to offload the liability in his books, or he want to account for the sale in his books, because now he has a agreement to sell. He would also want to book the entire transaction of sale of 2000 tons, which he is not otherwise allowed, because the risk and reward is not transferred. However, at times the buyer gives him unconditional undertaking that he has entered into a final agreement of sale. So he asks the supplier to cut invoice for the entire 2000 tons. Now the supplier is in a position where he has a sale transaction of 2000 tons, but he has not received the money for entire 2000. So he would want to assess the business risk. He wants not to pass on the entire quantity of sale till he receives the money. So what happens is, he would then write to the tank farm, or the storage tank owner or the operator, to say that, look here, I have sold these goods to XYZ, but the ownership will lie with him, but you will enter into, you will allow the delivery of the goods as per my instruction only. Now there is a conflict. The sale agreement says that there is a transfer of property. The business risk does not allow the seller to to the buyer to allow to take him entire delivery of the stock, because his security is not there in terms of the payment. So he enters into some sort of an arrangement whereby he allows the buyer to take delivery only to the extent of quantity which is paid for. Now he enters into a contract for storage of these quantities, and he does not allow him to take the delivery to the extent for which he is not paid. So here he now earns something called as interest on the amount which is delayed taken for delivery, or interest and the recoupment of warehousing charges, the tank charges, or the logistics charges. All these amounts, the issue is, would that form part of the sale price for the purpose of valuation? Would it form part of the valuation under section 15? That is the question. Once again, one will have to study the contract, because the risk assessing officer of the selling company would be always wanting to guard his pricing, his recovery of the amount. So he would want to be very slow in agreeing to pass the property in the goods. However, for the purpose of the buyer's discounting of the to raise the finance, he would want the entire property. He would say that I want to have this full sale invoice of 2000 quantities in our example, and that is how the contract is very delicately, I would say, worded. So one will have to go through the contract to understand whether this would form part of the valuation under section 15 in this case. Merchant export. Now in case of merchant export, we have concession rate of GST at 0.1%. Of course, the conditions which is given in notification 40 of 2017 have to be cumulatively followed and will have to be strictly adhered to earn this 1.1% concession rate of tax. Well, there is possibility that the export happens at a later than 90 days. In that case, the seller will have to raise a debit note for the differential in rate, and then let the buyer claim the input tax credit and go for the refund as the case may be. If he is eligible, let him go for the refund. Secondly, practical difficulty here arises is, how do I raise a debit note? Or let us say the rate of tax on the product is say 12%. How do I raise the debit note of 11.9? And how do I report in the GSTR? Financially, it is possible for me to raise a debit note of the differential rate of tax for 11.9%. However, for reporting in GSTR 1, it becomes little challenging. So it would be appropriate to pass a credit note for 0.1% and raise a debit note for the entire 12%. That is better and easier to communicate on the GSTR 1, to report on the GSTR 1. Supply to SEZ. Who is to use these goods for export? Now, is it possible to levy 0.1% GST based on the notification? Friends, to my mind, if the SEZ unit is to use this thing as a trading activity, one can do it. But if SEZ unit is to use them in the manufacture, and the manufactured goods are going to be exported, the concession rate of 0.1% is challengeable. It is out of, it is not out of or free from doubt. Now at times what happens is, the merchant exporter sources goods from different suppliers. He purchases in lots and then he takes it to the warehouse, and then he packs them, unpacks them, he does the grading, etc. And then he does the bulk loading, because it is quite possible he would source this thing from 10 suppliers. He would purchase 1 tons from, let us say, 5 suppliers, 10 tons from other 6 supplier, and totally 15 tons he may dispatch on exports. In such cases, that bulk loading is also possible. Such cases, the availing concession rate of 1.1% is possible. Now the point arises is, from when to compute the 90 days? For each such inputs, each such buying by this merchant exporter, 90 days will have to be separately computed. For each such lot of purchase, he will have to comply the 90 days of restriction of exporting within 90 days, specifically for each transaction, each lot separately. One can also not forget the COVID relaxation which is given in 2020, as may be updated later on. So one will have to see whether this 90 days condition is met or not, and accordingly take the benefit of 0.1% concession rate of tax. Now sales to EOU, export oriented unit. Can this deemed export or supply to an EOU, can you make it as supply under LUT? Can you supply under LUT? Friends, the deemed exports on exports, the supply to an EOU is not covered by the what we call is exports, or like section 6, just missed that wording, and accordingly LUT cannot be used against such supplies. Since the tax is collected on sales transaction, rule 42 would also not apply. I'll just see where is this. Anyway, go further. Now exports and refund. Now for commodity exports, for the goods export, there is an automatic refund processing when the goods are exported with payment. Now this automated system works in a way that the IceGate portal maps the transaction of the reporting in the GSTR1. So if the IceGate reporting and the GST reporting in GSTR1 is matched, the export refund for the with payment export is automatically processed. However, there are some issues when such reporting, we have some inherent errors in entering into data. At times the shipping date or the shipping document number, bill of lading number, etc. do not match, or it is not uploaded or incorrectly uploaded. In case of liquid cargoes also, at times the quantity do not match, so that there could be a challenge. Otherwise, online refund application is not required to be made, because it is covered by the automatic refund processing. However, if you were to export using LUT, then one will have to file an application for online refund, and then the refund gets processed. Friends, for refund, one will require a full session of the difficulties for refund and how this gets available, etc. But suffice to say that if the application for refund is made properly, online refund do get processed smoothly. The challenges or the practical difficulty one would have to take a call on, or one would have to be what we call alert about, is that should I file monthly application for refund, or should I opt to add a few months, make a combined application for several months together? Friends, the issue here is, how do I maximize my refund? As you know, Rule 89 provides a formula for the maximum refund which is available in cash. Now, the maximum refund is the ratio of my or the variables which I have in respect of the balance available on the date of export, balance available at the time of on the date of application, and the ratio of my exempt supplies, rather my exports to my total supply, exempt plus taxable. Now, on that ratio basis, I will have to see whether doing for 1 month, 2 months, couple of more months together, it gives me higher input, higher refund, or it gives me refund on a standalone basis on each month. Now, each category of refund is a separate application. So one will have to try and see and maximize the refund based on the calculation one would takes it, and then one can apply to see that maximum refund is available. Now, these large players also have certain export of services. Now, these are different kind or nature of services which these companies render to their, typically to their group companies in their other countries, or their head office if they are representative in India, or their what we call is principal company or holding company in the other country. So these services, I've just jotted down few of them. The market survey. So these companies, what they do is they continuously employ and engage various agencies to do a market survey. Let us say, if I were to say that the company is dealing into oil seeds, they will have a data analyzed for the sowing of the, let us say, soybean in India, in Indonesia, in Malaysia. What is the acreage which is covered? What are the predictions of the rain this year? Based on the IMD's forecast, they will see what is the likely yield, what is the likely consumption pattern in the particular area, what is the likely demand, and what are the likely factors which will play out in the demand and supply mechanism to ascertain the expected price when the crop matures for harvesting. Now, all these market surveys are done starting from the sowing season till the monsoon, and later on various other weather conditions to see what is going to be the yield, etc. All these services are also given to the and by way of advisories to the principals in the other country, or the head office, or the uh, uh, other companies outside the country, or to the companies in India as well. So such export services also take place. They also do a lot of analytics based on the huge data that they have. They also do some market analysis and research, uh, including the government policies and the issues and advisories that they give it out to the other companies. So such export services are very typical, which these large players enter into, because they have the resources in-house, as also the agencies they employ or engage, and that for that reason they are in a position to give these export services. Friends, it is important to understand whether these services are export of services, or these are recoveries in addition to their export of other goods. Ideally and normally or generally, these services are independent of the contract of export of goods they would have entered into with the same parties, because normally export of goods would happen based on the availability of stocks and the market, or the quality of stocks which is made available, the delivery schedule and the payment terms, etc. Whereas these services are independent of those export of goods. So one cannot say that these are coupled together as a realization of the additional sums of money for the export of goods. Intermediary services. These companies also provide indenting agency services. So when these are intermediary services, one will have to take call on the exposure to GST based on the intermediary services. These companies also have some peculiar import of services. If they were to enter into a contract for import, let us say of continuing with the same example of soya seeds from Indonesia, they may enter into or they may engage a surveyor before the contract is finalized or at the time of loading of the stock of the goods on the ship, to see the quality or the quantity which is loaded, or the survey of the market for the fluctuation in the pricing. Should they take the delivery, should they defer the delivery, etc., etc. So such is peculiar. At times, for selection of the lot, they engage specialized agency to help them to select a lot. Let us say if diamond packet of diamond is to be purchased by a site holder, they typically engage services of a uh, uh, professional to help them to select a lot of the diamond. Now, when I say lot of the diamond, which is typical, each lot is costing around 25 crores of rupees each lot. So they engage a uh, uh, specialized agency to help them to select lot out of say 20 lots which are available for sale, which lot to pick up and what price to quote. So in these cases, based on the potential of the rough diamonds, what it would fetch as the final polish, what yield will it give, the total quantity of polished diamonds out of this, based on the expert advice, such lot is selected. So all these are peculiar import services on which IGST is payable. Ocean freights. Friend, the discussion on ocean freight is very apt in this season, and my session cannot complete unless I take up this subject. Of course, I have some more time to talk about and I have something more to share also. Nonetheless, ocean freight now. The ocean freight IGST is payable on a reverse charge basis. Now we have typically two types of contracts: CIF contract, cost insurance and freight, vis-a-vis free on board value, FOB contracts. In both contracts, in the contract of CIF, the price which is entered into or understood or payable for the import cargo is inclusive of not only cost of the material but insurance and freight as well. So the freight element of the transportation from, let us say, Singapore to Nhava Sheva port in Mumbai is included in the cost of the entire cargo, which I am going to pay to the importer. In typically these cases, the transport is arranged by the exporter. He enters into contract with the freight forwarder or the shipping line, and he books the cargo. And accordingly, the freight is sitting as a element of the pricing in the CIF contract. Whereas in FOB contract, it is a free on board contract. The freight for the shipment is to be paid separately by the importer to the shipping line. So in case of CIF contract, the controversy is, do I need to pay a RCN thereof? Am I a recipient of the services of ocean freight? And that was the issue which was taken up in the Mohit Mineral Scales, initially before the Gujarat High Court and later on before the Supreme Court. and the Supreme Court ruling came in, the Gujarat High Court gave a favorable decision in favor of the SSE, saying that RCM is not payable on a CAF contract. The Supreme Court confirmed the decision of the Gujarat High Court, and it says that what is the contract in a CIF basis? The contract of import is the contract which has three elements: the cost of the material, the insurance for the transit, as also the transit freight, the shipment charges. So all the three elements are part of a single contract, which is a composite contract having the supply of the material, insurance, and the freight as a composite one. There could be more than one supply, but these are composite supply, and this supply is one supply on which the IGST is paid on the import, and for that reason RCM is not payable on the CIF contract. Categorically, this decision of Mohit Minerals has not touched upon FOB contract. I strongly believe FOB case, the importer of the goods enters into contract of the shipment of the freight from outside India to India, and for that reason on that RCM is payable on the ocean freight. What happens and what has happened in past, because of this controversy, certain CIF contracts, the importers have either not paid the RCM or they have paid under protest. Let's look at the two scenarios. The scenario where RCM is not paid. Since RCM is not paid, he has not claimed ITC of the same if he is eligible. Since he has not paid, he is neither paid nor claimed ITC. Since now it is held that RCM is not payable, he is not to do any act. His stand is validated by the Supreme Court's decision. In a case where RCM is paid and ITC is claimed, once again, since he has already paid the RCM and has availed the ITC, he is revenue neutral himself. He has paid the tax, he has availed ITC, there is no cost to him. However, there is small community of the guys who have paid the RCM under protest, but since their products, let us say he is importing pulses, pulses do not attract GST. Since these are exempt supplies, the RCM paid is to be reversed under Rule 42, and for that reason he would not be eligible to claim ITC. In such cases, he has paid the tax under protest and he has filed the application for refund. What would happen to that? Such refund application in majority of the cases have been rejected. They are either in appeal or they have reapplied depending on the limitation. And such appeals are either rejected or they are pending. The rejected appeals now are to be once again appeal against by a second appeal before the tribunal, but tribunals have not been constituted. Since tribunals are not constituted, no second appeal could be filed. They are sitting on such rejected appeal orders. Now, the issue to be examined is, can these refunds now be claimed? To my understanding, to my study, I believe such refunds can be claimed for two reasons. A, these refund, depending on the application, the limitation for application, one will have to see such refund applications can be now filed, and if such refund applications are filed, one can revive those applications by filing appeal, etc. Because tribunals are still not constituted, you can still go or may go by the writ route to claim the refund of the same. Of course, this is going to be little litigative, but when the stakes are high, one is not feeling shy of claiming the refund by approaching the appropriate high court of the states. High C purchase. Now the small issue is who will pay the IGST on the high C purchases and who would pay the RCM on the ocean freight. The high C purchaser, one who files for the bill of entry for home consumption, is the importer under the customs who is liable to pay the customs duty. The IGST is payable when the customs duty is payable, and for that reason the person who files for bill of entry for home consumption is the person who is liable to pay IGST, and in an appropriate case where ocean freight is payable, the such high C buyer will have to file for the RCM on ocean freight. Why this question I have taken up is, this understanding is very clear with everybody, but what I have taken is several cases the high C seller on conservative basis pays the ocean freight on RCM wherever it is payable and claims ITC. He is saying that I am revenue neutral, only there could be a timing issue. I will rather pay the RCM, claim the ITC and buy peace. Friends, the legal position as I discussed is the case where the IGST is payable, the ocean freight, if it is in a case of a FOB contract, the ocean freight is also payable. RCM on ocean freight is payable at the time of filing for the bill of entry for home consumption only. Now, bill to ship to transaction, in a standard transaction there are no issue. We need not discuss about it. In a case where bill to ship to transaction with a delivery happens to a job worker, let us say I am dealing in large quantities of paper and the buyer wants the delivery to be given to the printer's premises who is a job worker for him. Now the difficulty arises in a very peculiar case. Now certain peculiarities which I am sharing it is based out of the personal experience. The manufacturer's billing software does not pick up the final delivery address. Now typically there could be some limitation of the software at the manufacturer's place. This also happens in a case of BPP packing material, BOPP films packing material, where at times the manufacturer's billing software does not pick up the final delivery address. The issue arises, who should make the e-way bill? Obviously, I believe in such cases buyer should step in and he should cause the e-way bill to be made so that his goods do not get stopped at the check post, etc. It is better to have a bill to, ship to, bill from and ship from, all the four information clearly mentioned on the invoice. This should help the delivery, it should help the generation of e-way bill, and it should address the unavoidable consequences. One can address those concerns. At times the deliveries happens late night from factories or warehouse where they either forget or do not mention the all four parties references, etc. Now such peculiar difficulties do take place when the goods are stopped at the check post the next morning. The entire difficulty or the entire lapses in the documentation is brought to the knowledge of the concerned parties and the running around happens. Either the goods get stopped at the check post, the tax is demanded, or the goods are confiscated, or the vehicle is what we call detained at the check post. It is better to educate the teams at the seller and the buyer's end, not only for making proper invoicing but also for generating proper e-way bills. friends, over the last 2.5 years of the e-way bill regime, things have settled much better now. People have understood the operations much better, and with the advent of electronic invoicing, a lot of things have been automated. Lot of things get auto picked up. EV bill also getting generated. Uh, so these concerns are now slowly getting addressed, and they're being eased out. However, there are chances that small errors may result into large liabilities. This is a very peculiar case which I'm touching upon next is accumulated credit. In a case of multi-state operations, what is observed is in certain states there is accumulation of ITC, accumulation of balances in the credit ledgers, input credit ledgers, and some states continue to result into making payments. One would be always inclined, the management of the company will be always inclined to see opportunities, to see if I would try and utilize the accumulated credit in one state so that the actual cash outflow, or I can encash those credits. The thing as it is today, such accumulated balances is nothing but a what we call adding to the difficulties of providing for the working capital for these accumulated amounts, the blocked amount. So what happens is one can look around for opportunities to utilize these amount when you have multi-state operations. What one can do is, let us say we have accumulated credit in say Uttar Pradesh, and I have liability happening in West Bengal. What typically one can do is, if my vendor is, let us say from Madhya Pradesh or say from Uttar Pradesh, I would take the order in the name of Uttar Pradesh and ask the vendor supplier to dispatch the goods to West Bengal. Internally, I will raise the invoice on the West Bengal so that I will be able to utilize the credits which is accumulated. Now, it is easier to say than done, but one will have to really sit back and try and plan a sort of strategy so as to try and see, by using this particular option, will I be able to utilize the accumulated funds. Now this will require some more planning and more discussion at the client's level, at the operations level, etc., etc. But one can try and work out some solution to hasten the utilization of the credit which is accumulated, which will speed up the utilization. Of course, we have to be within the four corners of the law. At times what happens is, certain cases the unbranded cargo is purchased, which is exempt, but the purchaser then does the branding. So what happens is, if I were to the unbranded cargo is exempt, for example green peas or wheat flour or atta, but when the it is loose cargo which is purchased, it is exempt, but when it is packed and sold under a brand, it attracts tax. So one will have to see what is branding. So let's refer to the definition which is given in the notification 1 of 2017. It is part of the notes at the end of the notification. After say 100 pages of the notification, this comes at the end. The phrase brand name means brand name or trade name, that is to say a name or a mark such as symbol, monogram, label, signature or invented word or writing which is used in relation to such specified goods for the purpose of indicating or so as to indicate a connection in the course of trade between such specified goods and some person, using such name or mark with or without any indication of the identity of that person. So this definition of brand is very wide. It covers not only symbol or monogram or label or a signature, but invented words or writing also. A typical style of writing a name would also constitute a brand name. So at times the issue is, if I may not own the brand, but I may be simply putting a corporate logo on the Atta's bag. I do not intend to sell it under a brand, but I'm still using a uh, corporate logo on the bag of the Atta. And these bags of Atta are not 1 kilogram and 5 kilogram, which you and I individually buy from the uh, uh, say stores, but these are typical 50 and 100 kilograms, which are sold to large biscuit manufacturers or say bakeries, etc., who buy it in actually truckloads. So all these cases, the issue is, just because the corporate logo is put, or say in case of other food processors, they buy say green peas in a, and the bag is having a corporate logo put in. Can I say that the brand name is used? So this is to be examined, looking at to the definition of brand name. So if the unbranded cargo is packed and sold to a customer under the brand name, would the exemption continue in the hands of the supplier? One will have to see the commodity and its classification in HSN, then examine the definition of brand name, then take the call whether the exemption is lost and this transaction will attract GST or not. Now, in the case of Miller, a job worker is asked to pack the third party's brand. Now, what happens is, I am manufacturer M. I am engaging a job worker to make wheat flour and pack it in the brand name of the third person, say the brand owner. Would the sale in my hand will be subjected to tax, or will I lose the exemption because the brand name is of the third person? Well, the classification of entry does not say that the brand has to be owned by the seller. The brand, whosoever makes the sale under a brand name, whosoever is the owner, such supply is taxable in a particular HSN. If that be the case, even if the job worker packs the goods in the name of the third party's ownership of the brand, still those transactions will be subjected to tax if the branding attracts the tax in particular case. You have peculiar difficulties when some agencies have a central purchase order placed with a bulk supplier, let us say MMTC or a Cotton Corporation of India, and dispatches from warehouses across the country in different states. Say MMTC or say Cotton Corporation procures cotton from various states, Telangana, Andhra Pradesh, Madhya Pradesh, Maharashtra, from all the cotton growing places it will procure. However, the head office enter into a single contract with Cotton Corporation, say Madhya Pradesh office. Now that is where the peculiar transaction takes place. Now invoices on the head office who has raised the purchase order, or invoices are done individually from each warehouse. What happens is, at times the Cotton Corporation of India will raise all invoices on the head office who has raised the PO. Let us say head office is in Mumbai, and the invoices are raised by each individual warehouse of the CCI. In that case, one will have to see the place of supply and see how the billing takes place and decide the nature of transaction as IGST or CGST and SGST as the case may be. The documentation may require, because what happens is, the difficulty is, although head office has processed centralized purchase order, the state would have received purchase order from the prospective customers. So in that case, head office will have to cut a invoice, bill to ship to invoice, and dispatch goods to a ultimate customer in the other state. So one will have to internally raise an invoice between the head office and the branch, and then accordingly manage the documentation. At times, the ultimate customer may be in the same state where the dispatches are to take place. So one will have to really draw this transaction on piece of paper, look at the place of supply, location of the supplier, bill to ship to transactions, and then decide the taxability of the same, whether 10(1)B is to be attracted, or 10(1)C is to be attracted, or 10(1)A will be attracted. All these transactions have to be looked into that way, and then take the call and advise the levy of appropriate GST. The fluctuation in prices and fluctuation of forex rates is also very common in this type of industry. At the time of import, the IGST is paid on the customs rate on date of import. Now, what happens is, when actual remittance is made, there could be the difference in the foreign exchange rate. Such fluctuation in foreign exchange rate, the fluctuation in foreign exchange rate, is IGST payable on this differential, friends? Or if there is a reduction, can I claim the refund of the IGST paid at the higher rate? The answer is no in both the cases. Please understand, IGST is payable on the date of the import and as per the value which is payable for the purposes of customs duty. Now, customs duty, the customs department issues the foreign exchange rate for that particular week or that particular fortnight. Based on that, the customs duty is computed, and corresponding to it, IGST is computed. So the IGST which is paid on that date is appropriate and correct. The foreign exchange fluctuation should not amend the payment of IGST or refund of IGST. Sometimes we have post-import discounts. What happens is, the discounts are offered post the import transaction. These could be on account of the turnover discount, on account of certain other terms of the contract which the importer has with the foreign exporter. Typically, IGST was paid based on the amount which was disclosed at the time of clearing the customs. As we discussed a while back, the customs duty was paid on that value, and IGST is also paid thereon. Since there is no reduction in the IGST liability, because there is no amendment to the customs duty which is payable, there is no question of reduction in the IGST liability and reversal of any ITC on account of the same. If I have paid 100 rupees as IGST corresponding to, let us say, 1000 rupees of my import value, I am not, and I have claimed that 100 rupees as ITC, there is no question of any reversal thereof. The typical issue arises is, the revenue may contain that this is an import of service. Friends, one will have to really see the nature of such discount. Is this discount the another name of the services which the importer has received, or rather provided? I stand corrected, because what happens is, in these cases, what happens is that they say that this was an incentive which was received, and the revenue may try and treat this transaction as import of services liable for IGST on such cases. Friends, this is very peculiar case, and one will have to go to the nature of transaction and see what sort of stand the revenue is taken and counter the same based on the facts of the case. ITC of common credit. Now what happens is certain bulk players, bulk trade players deal into exempt as well as taxable supplies. If I were to take an example of a agri produce, he may be dealing in, let us say, pulses as also edible oil. Edible oil is taxable, whereas pulses is exempt. So there could be a exercise for working out the ratio of exempt vis-a-vis taxable supplies and the reversal of the common credit based on the section 17(3). So how to calculate the common credit? Normally one would have to work out the credit which is claimed for exempt supplies and for taxable supplies. The inputs which are for exempt supplies and taxable supplies, normally these are earmarked. Let us say if there is a storage of the pulses that is separately available to me, and storage for edible oil would be different. So vendor wise there could be classification available to me. In the same godown, if I am storing pulses as also cotton bales, there would be some logical amount or logical basis to divide the monthly rentals of the warehouse based on the area occupied, based on the period for which it is occupied, and accordingly one can say that this amount can be attributed directly to exempt supply, this can be attributed directly to the taxable supplies. So if that exercise is done, what is left out is common. The challenge is, should it be calculated on a monthly basis? I may have the ratio skewed in favor of exempt, in favor of taxable on month basis. One will have to really see, it is quite possible the season for my pulses could be different from the season for my cotton. My storage, my use of other common credit could be specifically different for different season to season. However, my common expenses of say establishment of my office or my godown staff which is there, which is common for there could not be any monthly fluctuation. For others there could be monthly fluctuation. So should I use my monthly ratio? Please do not forget rule 42(2) requires me to review the entire year's working at the year's working at the year end. So my entire year's working need to be reviewed at the year end, and I have to take a corrective measure for recalculation of my reversal. At that time, should I once again look at to my monthly figure which I have a pinpointed answers? Well, this is a very difficult situation based on the fact, and if one is very strong on the facts, one may stick on to the monthly basis calculation and make ground to defend the monthly calculation which is in his favor. However, at the year end, the ratio could be absolutely adverse, requiring more reversal also. Or if it is quite possible that the year end ratio could be favorable, requiring you to reclaim the credit which was reversed earlier. In either cases, the advice would be to follow the system consistently. Do not change the system on year basis. This could lead to complications and the non-acceptance of such method by the revenue authorities. Now at times you will observe that the exempt supplies could be only few months when there is a season, otherwise there would not be. So should the ratio be reworked? One will have to, once again, as I said, one will have to go on the facts very strongly, and then and for that reason one should then decide whether to go for a yearly review or not review. There is another peculiar case for export with pay. One when say that when I'm exporting the goods and I'm offering such transaction with tax, What should be my reporting? Let's look at the facts that will help us to answer the question. Export invoice is dated 29th of May 21. The bill of lading date is 3rd of June 21. In which month should I report this transaction? In the month of export, that is in the month of invoice of export, that is May month, or June month in these facts? Should it be as per the date of invoice, or should it be date of the bill of lading? Friend, I will have to see the provisions of the tax invoice and time of supply for these purposes. Before that, let's look at what is the export procedure. I need to raise a commercial invoice, which is a provisional invoice, which enables me to file the bill of lading. So let us say in my case, the export invoice was cut on 29th of May, which was actually a provisional invoice. Why provisional? I will touch upon in a while. After the bill of lading is filed, the cargo is taken on the board, and the bill of lading is issued. After the ship starts sailing and the goods leave the customs area within period of 30 days, as rather I believe maybe 60 days, I am not very certain, the export general manifest EGM is required to be filed by the shipping line. That EGM picks up the date of billing, bill of lading, and notifies that the goods which is loaded on the ship has actually crossed the custom station, so the export is confirmed, based on which the completion of export takes place and the ice gate record gets updated with the export having confirmed by the filing of the EGM. Now these are this is the procedure by which the export gets confirmed by the customs authority. Now look at the time of supply provision. Section 2.2 talks about when do I cut the invoice. It says earlier of the following date of invoice, the date on which the supplier receives the payment with respect to the invoice. Either of these here. In my case, my date of invoice is 29th of May. So that is the date I pick up because I have not received any payment for the same. So date of invoice is 29th of May. Section 31 talks about tax invoice. It says that the tax invoice should be made before or at the time of when the delivery of when it involves removal of goods for supply to the recipient, section 31(1)(a), and when the delivery goods or markup is made available, not markup, I stand corrected, made available, delivery goods or it is made available to the recipient. In my case, I cut the invoice on 29/5. So obviously one would be saying that I should report the transaction on the date of export of invoice and not on the date of billing, cutting of the bill of lading. Friends, majority of the cases, the export with pay transaction are reported based on the export invoice. However, there are a handful of them which believes that the export is complete only when goods are accepted on the ship, when the captain of the ship issues the bill of lading through the shipping line agent and EGM is filed. Why I say this transaction is based on provisional invoice? Because what happens is when the cargo is loaded, at times the captain does not accept the entire cargo. Let us see, if I am exporting 100 tons, after loading 90 tons, for whatever reason, the captain does not accept the balance 10 quantities. So in that case, even if my invoice was cut for 100, my bill of lading will finally get made for only 90 tons. In such cases, I have to follow something called back to the shore or back to country procedure, whereby these 10 quantity is once again brought back under the customs procedure to the shore, and they are brought back into the common mass of India. Now back to the shore procedure is something what is required to be done there, and that is why when the commercial invoice was made to enable the shipping line to make the bill of lading, that becomes a provisional invoice. And for that reason, the argument is that in such cases the date of bill of lading should be the date on which I should report my transaction in GSTR1. Friends, as I said, this is a very peculiar position some exporters have taken. However, majority of the cases, the export transaction with pay is reported based on the tax invoice or the commercial invoice which is issued. Friends, I conclude my presentation, and I thank you very much for the patient hearing. If the organizers allow, I can take a few questions at the end. Thank you very much. Do I stop the presentation now? Yeah.
Sir, first question is, please convey GST implication in respect of arbitration award received in 2002 in respect of sales made during 2018-19. Please provide your considered view regarding the contents of credit note, etc. to migrate adverse impact, if any. What rate the arbitration award amount will be taken under GST?
See, arbitration award is given in the GST period for the sale which was effected in GST period. That is the question. How should we deal with it? The taxable event is the event which took place in 2018-19. The arbitration award for the price has replaced the original price with the price which is as per the award. For that reason, what debit note, credit note is to be given effect to has to replace the original contract of sale. As per provision of section 63, debit note and credit note has to give effect in the month in which such debit note or credit note is accounted for. If after the passing of the award, if the arbitration award is received in 2022 and the let us say in the month of June 22 it is accounted for, the appropriate effect in the debit note credit note will have to be made today in the books of accounts and accordingly have to be reported in GSTR1 today. Yes. Whether the rate of GST on the recoveries will be the same as applicable to the underlying goods, whether cess will be part of the sale price of computing GST, please advise. Now, please understand, the recoveries as we discussed in the presentation is the part of the same GST price mechanism or the valuation. The value of the goods sold has various elements. Some elements of, let us say, carry charges which are discussed is the same goods which quantifies at a later date. The contract has provided one fixed element of price and the other variable element. The variable element happens when the recoveries is crystallized. So that carry charge gets crystallized when the delivery is lifted and the debit note is raised. So that debit note will attract the same rate as it attracts to the original goods sold. Now, when I say whether cess, so you're talking about cess on the coal will be part of the sale price for the computation. Cess is separately to be computed on the taxable value. In case of merchant export, how can buyer get refund of the excess of GST of 11.9 charged by the seller? Friends, it is the same GST. The buyer can also claim refund of 0.1%. Now the challenge is this balance 11.9 has not migrated automatically through IceGate because IceGate had the original invoice which was reported. So to that extent, there could be a practical challenge and a refund, to my mind and to my experience, is granted in such cases, but it takes little extra effort to get this processed. In case of refund of exported goods with payment of tax, it was correctly disclosed in GSTR1, incorrectly reported in 3B in B2B instead of export. what to do? 3B is not amendable. Yes, there are such difficulties which has happened. It was reported into B2B. So what happens is, in such cases GSTR1 is mapped with my IceGate record, so my refund processing should not have any difficulty. So I am not sure why you are stuck with the 3B. 3B vis-a-vis GSTR1, you can receive a query as one of the parameter, maybe 79 or 80, where there could be a mismatch between GSTR1 and 3B, that you can separately answer by way of a what we call written communication to your appropriate officer. However, for refund processing, there should not be any challenge. What is the IGST implication in case of FOB contract where importer directly engages the transporter? So friends, I did talk about FOB contract. The ocean freight is the recipient of service is the importer, and he has to pay the reverse charge on the ocean freight. According to you, he is liable to pay GST under the same, but as his underlying nature of transaction is the same, should the SC decision not apply? Friends, if you were to read the decision of the Supreme Court in Mohit Minerals, it is with the facts of only the CIF contract and not on FOB contract. And FOB contracts is a concluded position which is accepted in the judgment itself. Company is India imports goods from company B in Japan, since these are customized. Can you take the screen little on the left side and a little up? मिश्रा जी जरा स्क्रीन ऊपर कीजिए. Okay. Okay, I now got it. Possibly I will be able to do it now. Okay. Engage is the again. What is the ages here? Please. A company
So
imports
salary
goods. Hi, the company is in India, imports goods from company B in Japan. Since these are customized goods, the Japanese company also charges design charges from part for part of the value of imports, or will this be nature of import or by Indian company? If these are one-time charges only on one import, regularly charges are not every consignment. See, please understand the nature of the designing charges. There are two situations you have yourself mentioned in the query. A, when these designing charges are for these particular goods and it is one-time charge for these goods. If that be the case, then this becomes part of the import value on which you should disclose the import value at the time of customs payment, and also pay the IGST accordingly. However, if you say that at the time of import these prices were not disclosed, obviously these designing charges would have been part of a separate debit note, and in that case these designing charges, I do not know why it is not part of the customs duty. That could be question on the customs calculations also, custom duty calculation also, but then in that case you will have to treat them as import of services. I am giving you a practical advice, not a correct legal advice, I am aware, but the facts is that you should pay the IGST based on the import of service. What would it be possible to convey GST rule relating to MRP to be mentioned in the packaging goods? How GST is computed, particularly when the seller would charge price lower than the there are right me screen. I am not able to understand the query. I go to the next. From where to take exchange rate for export of service, RBR or NSC? RBI rate, because for export of services, convertible foreign exchange comes at a later date. For the reporting to the for the even export of software, one takes the rate which is given in the SoftTech form. Rate, while the Supreme Court has rendered a decision holding that such freight is liable to IGST, is not liable to IGST if the custom officer insists for payment of such IGST as prevailing IGST provision, time of clearance of good, what recourse could be taken? First thing is we'll have to educate the customs officer saying that now IGST is not payable on the CIF contract on the ocean freight account. If he does pay it, he will have to apply for, I mean, if it is ITC available, practical advice will be to pay it and claim ITC. There could be a timing issue. If there is accumulation of ITC on this account, pay under advice, pay under protest and file for refund as excess tax is paid or tax wrongly paid. I think that's all. If the screen can be taken down further, I can read it further.
Sir, all done.
All right. Thank you, WRC, for the opportunity granted, and thank you all for a very patient hearing.
Sir, now it's a time to vote of thanks to you, sir. CA Rajat Talati, sir. Just one quote I can say: a good speech should be like the first time you say something, it is heard. The second time, it is recognized, and the third time, it is learned. So yours, the today's webinar and today's the detailed slides and everything you had explained in detail, and also you had taken all the question answers very diligently. So I, on behalf of WRC, give you the hearty vote of thanks. Thank you, sir.
Thank you very much.